Good afternoon, and welcome to this month's webinar about Roth IRAs, death and taxes, how to beat one of them. I want to remind everyone that these webinars are recorded, and the recording will be available online down the road, along with all past and future webinars. My name is Jameson McCandy. I'm an advisor at Appella located in Portland, Oregon. I've been with the firm just over 3 years. I'll be the moderator for today's session. We encourage questions, so send those throughout, and we'll get to as many as we can at the end. Just a personal note about Roth IRAs. I think they're amazing wealth building tools. There are benefits to investors at all stages of life, especially to young people. Many of the strategies our presenters are going to discuss, maybe things you've never thought about, and I'm sure you're going to learn a lot today. Now I'm going to get to our presenter introductions. Cameron Holloway is a resident financial planner in our Huntington Beach, California office. The Huntington Beach office specializes in working with divorcees and widows. When he's not working, you can find him out exploring the great beaches in Orange County on the weekends. Ed Richter is a senior financial advisor and partner in Appella Wealth's Lenox, Massachusetts office. He's a tax specialist and enjoys consulting with Appella advisors around the country on complex and interesting tax planning cases. When Ed's not working, you'll find him playing table tennis, think Marty Supreme, noodling on his cello, riding his e-bike, listening to jazz, and enjoying family. Gina Sharonis is a senior advisor in Irvine, California. She has an extensive background both as an investment advisor and CPA working with C-suite executives with equity compensation as well as business owners. On any given Saturday, you can find Gina hiking in the Orange County wilderness with her yellow lab, Chunk. Nick Levinson, last but not least, is a senior advisor in our Oakland, California / Chicago, Illinois office. He joined Appella in late 2025 and previously co-founded and co-managed Park Piedmont Advisors, a financial advisory firm with clients in California, New York, Florida, and Illinois. Outside of work, Nick has been focused on honing his paddle game. And now I'm going to pass it to Cameron, and he's going to kick us off here.
Thank you for that introduction, Jameson. And in this first section, we'll be going over the fundamentals of Roth accounts and highlighting their tax-free growth and some key rules. Now, first, a Roth account is a type of retirement account. And compared to traditional IRA or traditional 401k plans, Roth accounts are funded with after-tax dollars. And since Roth accounts are funded with after-tax dollars, their investment earnings compound without yearly taxes, allowing for greater long-term returns. Another bonus of Roth accounts are the tax-free withdrawals. And with these, you won't make any tax payments upon distributions. But however, you must meet two requirements for these tax-free withdrawals. The first is that your account must be open for at least 5 years. And if there is a withdrawal before the 5-year period is met, only the earnings withdrawn will be taxed at the ordinary income rate, as contributions are always tax-free upon withdrawal. And the second withdrawal rule is that you must be at least 59.5 to be eligible for tax-free withdrawals on earnings. However, there is flexibility with this rule, as we will see later on. Another fact to know is that max individual contributions for 2026 are $7,500 if you're under 50, and for those above 50, you can make an extra $1,100 catch-up contribution on top of the original $7,500 contribution. These maximum contributions are only allowed when earned income is above $7,500 or $8,600 for those making the catch-up contribution. So if you have earned income for the year less than these amounts, you may only contribute up to what you have earned. And an example is if you earned $5,000 this year, you may contribute up to $5,000 for the year into your Roth account. And for high earners, there are phase out ranges. For married filing jointly filers, if your modified adjusted gross income is above $242,000, you will be ineligible to make a standard Roth contribution. And for those that are single filers, you will be ineligible to make a contribution if your modified adjusted gross income is above $153,000. And if you are in these phase out ranges, don't worry, as there are still ways to make the maximum contributions. And my colleague Gina, she will review those later on in the presentation. To review what we have covered so far, Roth accounts are made with after-tax dollars, compared to traditional accounts where contributions are made with pre-tax dollars. And withdrawals in Roth accounts are tax-free if they meet the two withdrawal requirements of the account being open for at least 5 years and the owner of the account being at least 59 and a half. Another bonus for Roth accounts is that there are no required minimum distributions. Compared to traditional retirement accounts, these begin at age 73 or 75 and can be a burden if they're not appropriately planned for. As mentioned earlier, a key rule to receiving tax-free withdrawals on earnings in Roth accounts is that they must be open for at least 5 years. Meaning, if you don't have a Roth open yet, please get one open. And once you make your initial contribution, the 5-year clock starts. And one of the adjustments to the age 59 and a half withdrawal requirement applies to first-time homebuyers. If you are a first-time homebuyer, you may withdraw up to $10,000 in earnings from your Roth account for your home purchase. And however, you may still only do this if that 5-year rule is met. So another great point is for even young adults like me, a Roth account has great benefits in that you can use an extra $10,000 in earnings to buy a house. And if you have a 529 account, after it is used for education, you may roll over funds up to $35,000 for one's lifetime into a Roth account. And the limits for these rollovers are that the 529 account must be open for at least 15 years. Only contributions made to the account at least 5 years prior can be rolled over, meaning if you roll over funds from a 529 to a Roth today, only funds that were contributed 5 years ago can roll over into the Roth. And the last requirement is that the Roth account must be owned by the beneficiary of the 529 plan. Since there is a lot of complexity within the 529 to Roth rule, we do recommend you discussing with your planner if this is something you're thinking of doing. And something to be aware of starting this year is that for high earners with wages above $150,000, 401k cash contributions must be made with after-tax dollars to a Roth 401k account. And to recap what we have gone over so far, benefits of Roth accounts include the tax diversification they give you, as earnings will always be tax-free upon withdrawal if the 5-year rule and age 59 and a half withdrawal requirement age are met, or one of the rules exceptions are met. And also, compared to a traditional IRA and traditional 401k plans, Roth accounts will never have required minimum distributions, allowing you to maximize your earnings for however long you desire. And if you plan on withdrawing from your Roth account or have funds left over, don't worry, as your beneficiaries will receive your Roth account without needing to pay taxes on it, which only boosts the power of these Roth accounts. And also, for estate planning purposes, inherited Roth IRAs receive 10 years of tax-free growth before you are required to take a non-taxable RMD in the 10th year. And these accounts, there may be some times, oh, go back real quick. Thanks, Jameson. There may be some times when contributions to a Roth account do not always make sense. And one case is if you expect to be in a lower tax bracket later or in retirement. And an example of this is making an after-tax contribution when you are in a 24% tax bracket does not always make sense if you expect to be in a 12% tax bracket later on or during retirement. And also, if you are looking to lower your current tax bracket, making more pre-tax contributions will be a better choice than making after-tax contributions, as the pre-tax contributions will lower your taxable income. And lastly, if you have a short time horizon, of needing the earnings from your Roth account, where you will not clear the 5-year period or make a withdrawal before age 59 and a half that doesn't fit with any of the exceptions we covered, contributing to a Roth account will not be the best decision. And now Ed will go over the importance of asset location and after-tax returns.
Thanks, Cameron. So I'd like to talk to you today about how to invest your Roth IRA or your Roth retirement account if it happens to be in a 401k type plan. It would be very easy for me to say, just invest your Roth for maximum growth. In other words, the stock market, considering that your Roth grows tax-free and distributions are not taxable as long as you follow the rules. And my presentation would be over right now. But we really need to go through the steps of how we get to that conclusion. And that's examining how different types of accounts are taxed. Most of our clients or investors don't only own one account, or in other words, a Roth, but they own different types of accounts. You can own taxable accounts, your individual joint or living trust account. You can have retirement accounts, such as your traditional IRA or 401k type account. And you can have your Roth IRA, which is forever tax-free. I'm going to walk through how different types of income are taxed and put some numbers and tax rates to those categories of accounts. And I'm going to discuss a particular tax strategy that we employ at Appella, and it's called asset location. It's a strategy that aligns client investments across all of the different types of accounts that they have with tax efficiency in mind in order to maximize after-tax returns. You've likely heard the old adage, it's not what you make, it's what you keep. What I'll be discussing will demonstrate how these asset location strategies can improve net returns, or in other words, what you get to keep. On this slide, you'll see that we have different strata of tax brackets based on the federal tax code, either joint or single tax brackets. They start as low as 10% for ordinary and 0% for capital gains. And you'll see that as we work through some of the lower tax brackets, the difference between ordinary and capital gains tax rates are significant, and they become even more significant at the higher tax brackets. First, let me step back and tell you the common types of income subject to ordinary tax rates, the left-hand tax rate column. So common types of ordinary income include your wages, pensions, retirement distributions, and Social Security. But specifically related to tax investment income, ordinary rates apply to interest income. Think of savings accounts, CDs, or bonds, and non-qualified dividends. Non-qualified dividends are dividends that don't meet the criteria for the lower capital gains tax rates, and I'll explain in a minute. And also, ordinary income applies to short-term capital gains, which are profits on selling assets or securities that you've held less than 1 year. So when we move to the capital gains tax rate column, those rates apply to assets that you've held for more than 1 year and sell them and realize the gain, or capital gains, qualified dividends are also subject to those capital gains tax rates. So in general, the difference between those tax rates are about 10% at the lower tax brackets and about 20% at those higher tax brackets. So some rules come into play when we're thinking about what types of assets to put in what types of accounts. So primarily, these tax rates apply to taxable accounts. So we want to make sure that the assets we put in taxable accounts are going to be subject to those lower capital gains tax rates, those qualified dividends, and those realized capital gains on long-term sales. Your income taxes on retirement accounts, meaning money you invest in retirement accounts and the distributions from those accounts, are always going to be payable at ordinary income tax rates. So you're kind of getting the sense now that we want to kind of load up taxable accounts with stocks generally, and we want to load up your retirement accounts with bonds or fixed income securities to optimize your net return. Of course, Roth accounts, we can still probably say load them up with stocks, given that they're forever tax-free. So next slide, please. So I wanted to mention that the Vanguard Group, they're the second largest fund company in the world. They did a study almost 2 decades ago, and they've updated this study throughout those decades. I've included a link to Vanguard's iteration of their most recent study on this slide, and you'll all be able to obtain these slides after today, so you can always go back and get the link if you want some good bedtime reading. But Vanguard, identified certain attributes of financial advisors that can lead to additional value for their clients. And this value they quantified as up to and exceeding 3% annually in net returns each year. And that includes financial planning, evidence-based investing, tax optimization, behavioral coaching, and other services they describe as best practices. Today, I'm going to focus on that tax optimization section of their what they feel are best practices. And tax optimization includes tax efficient retirement contribution and distribution planning, tax loss harvesting, and tax location. So they gave an example of a client who have half of their money in taxable accounts and half of their money in retirement accounts. And they could choose to put all stock in their taxable account or all bonds in their taxable account. And what they determined was that by keeping the stocks in the taxable accounts and keeping the fixed income securities in the retirement accounts could lead to 1 to 1.5% of excess annual returns. Next slide, please. I'm going to give you our methodology on how we invest um, client accounts when they have different types of accounts, including Roth, taxable, and regular retirement accounts. So first we have to determine someone's asset allocation strategy, anywhere from no stock to 100% stock. And in this case, we have a client who has a strategy of 50% stock and 50% fixed income. So what we would do is we would first load up the Roth accounts with stock. We would then load up taxable accounts with stock. And if there's any more stock to be allocated within the stock strategy, we would put it in the retirement accounts, the taxable retirement accounts. And then we would put the remaining fixed income in the retirement accounts. If a client has a risk adverse strategy and we have to put stocks in different accounts, we would lean to the stocks that provide more qualified dividends subject to lower rates in the taxable accounts, and the stocks primarily in foreign stocks in non-qualified or Roth IRA tax tax accounts. But to summarize, in a balanced allocation strategy, most, if not all, the fixed income would be located in retirement accounts. And that's exactly the example you have on the right-hand side of this slide. It shows them where we're investing $1 million for that 50-50 strategy. We're going to put $100,000 in stock in the Roth account, $400,000 of stock in the taxable account, and the remaining fixed income would go in the taxable account and the IRA account. So we've fulfilled the strategy in the most tax efficient way. So just to summarize, generally, again, your Roth IRA should be invested in stock unless you have a very risk averse and low stock strategy. And in those situations, you might find that your Roth should include either fixed income or foreign stocks, which generate non-qualified dividends. And I'll also point out for any of the young savers who are listening today who may be in low income tax brackets, Roth contributions, we usually suggest they make their retirement contributions to a Roth over a traditional IRA account because of their lower tax bracket, and that the types of investments we normally suggest are index funds that invest in entire world stock markets. We call that a one fund solution, and find that that's a good option as younger investors accumulate savings. That's all I have for today. Thank you. I'd like to introduce Gina Sharonis.
Okay.
Thanks. Backdoor Roth IRAs are designed for people whose income, as Cameron mentioned, might have made them eligible to make a direct Roth IRA contribution. So, what is a backdoor Roth and how does it work? It's just really another way to get funds into a Roth account. It involves a two-step process where the individual contributes first to a traditional IRA account and does not take a tax deduction for that contribution. So it's considered, it's called an after-tax contribution, and then transfers the funds as quickly as possible over to a Roth IRA account. So it's pretty simple, pretty straightforward. and avoids the income limitations. There are no income limitations on this type of strategy. So just want to refresh your memory on the income limits that Cameron mentioned, because obviously making a direct Roth contribution is easier and just more straightforward than doing a backdoor Roth. But if you do exceed these limitations on your modified adjusted gross income, so it's not your taxable income, it's your gross income, then this is just an alternative. And backdoor Roth is just an answer to that problem. So how does it work? Basically, the dollar amounts are the same as the regular Roth contribution limits. So $7,500 for people under age 50. And for those 50 plus, $8,600, which includes that $1,100 catch-up contribution amount. And of course, as Cameron mentioned, you've got to have earned income of at least that amount on your tax return in order to qualify to do this strategy. There are some rules that apply to backdoor contributions that don't apply to direct Roth contributions. So obviously earned income does, and there's no deduction, which is similar to the Roth, direct Roth. But the backdoor Roth is subject to something called the pro rata rule and also requires that you file a special form along with your tax return called a Form 8606. And we'll talk more about that in just a minute. And I want to walk you through the steps of a backdoor Roth contribution. So first, obviously, you have to have both an IRA and a Roth account. And you could set these up at a Fidelity, Schwab, Vanguard, probably your bank or credit union. We like Schwab and Fidelity at Appella. But the amounts are the same. So you want to make the non-deductible contribution to the traditional IRA account, the 7,500 or 8,600 if you're over 50 for 2026. Do not take a deduction on your tax return. Leave the money in cash. So while it's sitting in that traditional IRA account, you do not want to invest it and incur earnings if you can avoid it. Then you want to transfer as quickly as possible whatever the contribution amount is over to your Roth IRA account. And then, of course, file the Form 8606 with your tax return for the year. So not too hard. So let's talk about the hard part, the tricky part, this pro rata rule. A lot of folks have old employer 401k accounts, maybe that they've rolled over to an IRA or a traditional IRA that you might have contributed to in previous years and taken a tax deduction for, or a simple or a SEP IRA. If you have any of those accounts with balances, then if you do the backdoor Roth contribution, strategy, you're going to end up getting taxed on a portion of that. And what the pro rata rule does is combines all your IRA accounts as if they were one account and then calculates the percentage that's taxable when you convert. So in our example, this individual has $100,000 in their IRA account. And when she converts or transfers the money from her traditional IRA over to the Roth, she's going to end up paying tax on most of that due to these other balances. So they're going to look at the percentage of whatever you transfer out as a percentage of the whole, and the remainder amount is going to be taxable. So to avoid this, there's a couple ways to avoid it. One is if you have an employer 401k, you can transfer your existing IRA into your current employer's 401k account. Of course, you want to look at the 401k plan account and make sure that's allowed and also make sure that the 401k is being invested wisely, and that there aren't a lot of fees in there. And that's something that I think your advisor can help you with. It's always hard to understand the fees in 401k plan accounts unless you really know what you're looking for. Another option is if you're a small business owner, is to open a solo 401k or an individual 401k account. And this really only works for small business owners. Um, and I'll talk a little bit more about that in just a second as well. Just want to give you um, a table with all of these confusing limits, because even for advisors, this can get confusing, and especially given that they change every year. But wanted to point out that the 2025 limits are different than the 2026 limits. The changes are highlighted in that final column in green. Um, you're still eligible to make a Roth or an IRA contribution for 2025. So there's an April 15th tax deadline. We're kind of getting close to that, so you'd want to do this very quickly. But you can still make a Roth, either a direct Roth or a backdoor Roth contribution, and roll it over and have done that for 2025 tax year. So common mistakes, frequently asked questions. The big thing here is filing that Form 8606, because remember, when you do the backdoor Roth, you don't take a tax deduction for what you've contributed. Um, and if you don't file the Form 8606, the IRS doesn't know that. They don't know that you didn't take a tax deduction. So at the end of the year, that's going to get reported on a 1099. So you want to make sure that you attach this Form 8606 to your tax return. Otherwise, you could potentially be taxed on the distribution from the traditional IRA to the Roth. So that's critical to take that step. You also want to provide the information on the 8606 to your tax preparer. So it's something we do for our clients in the Irvine office, and I think Appella-wide, is to make sure that our clients' preparers are aware that they've done this, if they've used this strategy. Again, you don't want to invest before converting, because if the market rises between contribution and conversion, then you've got taxable gains. So we want to keep the contributions in cash and convert as quickly as possible. Yes, it's a legal strategy. The IRS clarified a few years ago that there's nothing wrong with this, with doing the backdoor Roth. And so, it used to be that people were a little nervous about it because of something called the step transaction doctrine, but that apparently does not apply here. Um, so don't ignore the pro rata rule. We talked about how to fix that if you are in that situation. And the tax filing deadline for 2025 is April 15th. For 2026, it's April 15th of next year. So you've got some time. And you don't need any sort of special account. You can just set up an account at your brokerage or bank. In addition to regular backdoor Roths, there's also a strategy called the mega backdoor Roth, which only applies for certain people. It can only be utilized for certain individuals, typically small business owners who have solo 401ks. So if you're participating in a group 401k plan with your employer, if you're a corporate employee, it's not likely going to work for you. Again, check with your advisor. They'll understand the limits and when it could work. But for those that it does work for, it's pretty powerful. The mega backdoor Roth involves contributions to a 401k plan, typically a self-employed business owner 401k, and that you can actually get every year up to $72,000 into a Roth account utilizing this strategy. Um, Typically, we recommend that the uh, business owner contributes the 24,500 tax deductible portion as their employer deferral, or sorry, employee deferral amount. But you can actually contribute that to Roth, to a Roth account with inside the 401k. You want to make sure your plan is set up properly to allow that, but most plans do allow it. Um, and then the remainder amount is an after-tax contribution. So again, no deduction that you're making via your paycheck, via payroll in the business. And so you can contribute up to 72,000 total as long as you have W-2 or earned income from the business of that amount. The 72, I think it's 72,000, yeah, in 2026. What we like to do typically for clients is have them contribute that amount. Again, it's a payroll deduction, so you've got to remember to do that at the end of the year or throughout the year, and then convert it from their 401k plan directly into their Roth account outside the plan. Um, you want to coordinate this. This is a really tricky process, this two-step process. It sounds simple, but the conversion can be a little complicated. And the really important part is making sure that your plan is structured correctly. So you'll need to know how it's set up. That's the important piece. So when you're establishing that solo 401k, and here's where you do need a special account, it has to allow both after-tax contributions and in-service withdrawals. And we work at Apella, we work with an outside provider who takes care of this on a really cost-effective basis. But not all brokerage firms provide this service. What you actually need is a third-party administrator, and there's a cost to that. Um, there are business tax credits that generally cover the first 3 years, 3 to 4 years of the cost. So it's not a huge expense, probably $500 a year after the third to fourth year. And for highly compensated employees, this is kind of the reason why most of our clients who work with bigger companies and are participating in a group plan. Um, if you're a highly compensated employee, which means that you've earned more than 160,000 in 2025, then you don't qualify to make this after-tax contribution typically. So really, again, for small business owners. So I encourage you to work with your advisor to coordinate this, as it can be very technical, and it requires coordinating your 401k plan administration along with your tax planning and your investments. But for self-employed high earners who have maximized traditional accounts, the Mega Backdoor Roth provides an unmatched opportunity to build substantial tax-free wealth. And you can also do it as a small business owner for your spouse if they work in the business. So incredible opportunity.
Perfect. Thank you, Gina, for that. And like I said earlier, last but not least, Nick, please take us home and we'll answer questions after.
Sorry, I was going to say we're in the home stretch for everybody listening. So hang tight for a few more minutes. We'll get you there. So my presentation is on Roth conversions. We've talked a bunch about the benefits of having different types of accounts, which allow you to diversify your tax exposure over time. Ed mentioned, the benefits of having Roths in addition to taxable accounts and tax deferred accounts. But then there's also the issue of limitations on getting money into Roths. As Cameron mentioned, there are income limits for the regular Roth contributions. More and more work retirement plans have Roth components to them, but not all of them do yet. And obviously, not everybody is necessarily working or working at a firm with one of these kinds of plans. So those limitations are in effect. So in addition to the backdoor options that Gina discussed, there is another way to get money into Roths, and that's through a Roth conversion. So the general idea with a Roth conversion is that you are converting pre-tax money from an IRA or 401k into Roth money. And that's great because you get the benefit of long-term tax-free growth and withdrawals. But there is a trade-off, as in many parts of the financial world. And the trade-off is that you have to pay taxes on the amount that you convert in the current year. So that in many cases, that's going to be a tax that you have to pay much sooner than you might otherwise, given the current required minimum distribution rules. So again, generally the idea is to work with your advisor to understand the nature of the trade-off and whether it works for you. And I'll go into that in some more detail as we go through. So the main benefits of Roth conversions, as we discussed already, you get in a Roth account, you get tax-free growth and withdrawals as long as you meet the 5-year and age 59 and a half rules. The Roths can be especially beneficial if you expect your tax rate in later on in life to be similar, if not higher, than what it is currently. It can be similar based on required minimum distributions that you have to take, or if you have an inheritance and start earning income off of that. And it also can be higher if rates go up, which they very, very well might in the future. Other significant benefits of having money in Roths through conversions are that you don't have to take required minimum distributions like you do in IRAs or workplace retirement accounts. The original owner of a Roth has no RMD requirement, so that's a significant benefit. Allows for accumulation of assets tax-free over the original owner's lifetime. There's some estate tax planning advantages as well. When beneficiaries inherit a Roth IRA, they have 10 years before they actually have to distribute the amounts in the account, and those amounts can accumulate tax-free again for those additional 10 years, which is a really significant advantage for beneficiaries. There's also a lot of flexibility in terms of conversions. There are no income limitations. You can convert any amount at any time. And so this allows you to work with your planner and tax advisor on doing strategic conversions. And this is a really important part of this process. So in a year when you have relatively low income, either if you're in a job transition or you take early retirement, and also if you're in the period before you take Social Security or start required minimum distributions, you can plan in those years to do the conversions, and you can do them in amounts that keep you in the current tax bracket. So there are a lot of strategic planning opportunities related to Roth conversions. Finally, it's a pretty straightforward process to do a conversion. You just move money out of a traditional IRA, typically into Roth IRA that you set up. You can do that, in any brokerage firm. Also, workplace plans now for the ones that have Roth components often allow for in-plan conversions as well. So that can be a decent way to get money into a Roth also. Okay, so in terms of downsides, these are the trade-offs that I mentioned earlier. The main one is that there's an immediate tax impact on the amount that you convert. So You get the money into the Roth, but whatever that dollar amount is gets added to your taxable income, and you have to pay ordinary income taxes on that income. Also, if you're not strategic about the conversion amount, you can actually push yourself into a higher tax bracket, and that would increase the taxes that you have to pay as well. So you need to be careful about that. There's another issue with how you actually pay the tax bill. And so the best way to do this is to pay the taxes with money that's outside of an IRA, so in a taxable type account where you can control, the tax implication, minimizing capital gains. If you have to pay the tax through the IRA itself, either you're gonna have less money to put into the Roth if you have a fixed amount coming out of the IRA, or if you increase the amount of the conversion to cover the taxes, then the tax bill that you have is going to be higher from that higher conversion amount. So not everybody has the flexibility to pay the tax bill out in a non-IRA account, non uh, tax deferred account, but so you just need to keep that in mind as well. Also, in terms of the 5-year rule, we talked about this a lot earlier with regular Roth contributions. Each conversion that you do, especially if you do this, on an annual basis, let's say through one of those strategic processes that we talked about, each separate conversion has its own 5-year clock. So you do have to keep track of that if you want to avoid taxes and early withdrawal penalties from converted amounts. Finally, in terms of downsides, large conversions can have other impacts on your tax return. Several, pieces of income or health benefits have specific dollar amounts associated with them. And if your income is above that, you potentially are going to pay higher taxes. So this can affect Social Security benefits. It can have an impact on Medicare premiums and a variety of other phase outs of deductions or credits that you have on the return. So you just need to watch out for that as well. In terms of takeaways, as we said, Roth conversions can be extremely powerful in the right situation. It's not for everybody, and it's not for everybody every year. But if you have that conversation with your planner, tax advisor, and it does make sense, it can be a really good way to get money into that tax-free part of your overall portfolio. It's important to have a general sense of how your future expected tax rates are going to compare with your current rates. Again, it's best to have money in Roths if you think your tax rates later on are going to be similar or higher than they are currently. As we mentioned, strategic conversions can be really important in years when your income is relatively low. And finally, we talked a little bit about the idea of paying the associated taxes with funds that come out of non-retirement accounts. So that's pretty much it for conversions. And I think we saved some time for questions. Jameson will handle those.
Yeah, thank you, Nick. I think we've got about 10 minutes for questions, and I can pull those up and see if there are some exciting ones here. Let's see. Um, Here's a good one. How can we strategize contributions? Well, I guess this question I think will be easy for whoever decides to answer it. How can we strategize contributions to Roths after retirement? And maybe it's more a conversion question, right? Because you can't contribute once you retire.
Yeah, that's the problem
Right.
is you've got to have earned income in order to make a contribution. So
Right. So it would,
unless you have some sort of deferred compensation plan, so a lot of professionals, have deferred comp, and that works. That's actually a great way to qualify.
So if you have, this is a question actually I don't know the answer to, Gina, but if you have deferred compensation that counts towards an amount that you could put into a Roth for a contribution.
Yeah, yeah. If you have a deferred comp, and that's you typically only see that at, the executive levels, so not very many people have that option.
But not like a pension, if you were a public employee or a teacher, that doesn't count.
Nope.
Okay.
Jameson, I would also just add that, depending on when you do retire in terms of strategizing, if you have a somewhat early retirement, again, before you start taking Social Security or before you have to take RMDs, that can be a really good time to do a conversion, as we just discussed. So that's definitely something to think about, depending on when you retire.
Okay. Here's another question. Um, why why does the IRS limit or put those limitations on Roth contributions for income? But then you can do kind of a backdoor conversion, I guess. And maybe there's no good answer to that, but who wants to take a stab at that one?
I would just say don't look a gift horse in the mouth. And, it's just one of those weird things. That's why people were nervous about doing it. Tax people were very nervous until I think it was 2 or 3 years ago, and the IRS released a clarification that said we're not going to apply the step transaction doctrine to this situation, and it's okay to do it. So who knows why? I've learned long ago not to question the logic of IRS rules.
Okay,
Well,
thank
I was
you.
just going to say with conversions, they don't mind the IRS and, state governments don't mind getting tax money before they otherwise would. So they
Yeah.
don't mind if you do it. But again, there's no that is the trade-off part that we talked about. So they do allow you to do it, but it's not the ordinary course of business.
Okay. Here's one for Ed. Um, like what types of tools do you have at your disposal when you're kind of looking at tax planning specific to like a Roth contribution or conversion or whatever the case may be?
Sure. So we have some really sophisticated planning tools at Appella. One is just our ordinary financial planning software, but we also have a tax program that's available to all of our advisors, and it allows us to do uh, single year or multi-year planning. It actually optically reads our clients' tax returns into the program, um, and produces some pretty sophisticated reports and projection um, uh, tools that allow us to go forward into the future and look at what does a Roth conversion program look like over what we call the donut years, uh, the years between a retirement and the requirement to start taking minimum distributions from ordinary retirement accounts that are taxable. So we can often, through a Roth conversion analysis, um, see how we can um, move money into the Roth through distributions at maybe, say, at the 12% tax bracket to avoid them being included in minimum distributions subject to 22 or 24% tax bracket. So some substantial savings. And if you're interested in that, talk to your appellate advisor and see if it's reasonable to go through the analysis.
Okay. Here's another question. This may be for you, Gina. This person says, I have an employer 401k where I have access to both traditional and Roth contributions. I've also made some after-tax contributions in this 401k. How can I check if I'm eligible for a mega backdoor Roth conversion?
Great question. So, step one would be to ask for the 401k plan summary plan description, or SPD is what it's called, and that's typically available on the website, the 401k website. When you log in there, it's under plan documents usually. Um, and there will be something in there that'll talk about, these types of transactions. It'll be, of course, it's buried on like page 43 usually, but that's where an advisor can really help you understand. And if you do call your 401k plan administrator, I don't recommend, I think typically the people that are going to answer the phone are not going to be familiar with these terms. And so you may want to ask to speak to somebody in their actuarial department, or in their, a technical person at the firm, if you don't have an advisor. But I highly recommend working with your advisor or an advisor on this, because it's really hard to get this information, but it is available. It should be publicly available or available to you.
Okay, perfect. There's a couple more questions. This person wrote that they have an annuity that was funded with IRA money, and that they're taking kind of the maximum they can take without a penalty each year. They're saying with this company that they can convert it to a Roth from pre-tax, and they're wondering if there would be an advantage to doing this. Um, I mean, you probably one of those questions where we need more information.
Mm.
Um,
Yeah,
but
because
just given that,
I would think there's going to be a tax liability on that.
yeah, sure. I mean, and it would probably depend on different, factors kind of in the overall plan. That would be kind
Mhm.
of my opinion. More information would be needed. But
Yeah.
I would definitely reach out if you're considering that. Okay. That is 2 o'clock Pacific, 5 o'clock Eastern. So I think we're all done here, but we appreciate everyone joining us this afternoon. And our next webinar is April 15th, which is an important day for other reasons. Like Gina said, you can, get your Roth contribution in between now and then. And the topic's going to be behavioral bias or biases. So thanks again, and we'll see you next month.